Boom, 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 boom. Welcome, everybody. Welcome, everybody. We are recording. Go ahead and get this live started. I'm going to pull up these slides. Share. I need some participation from you guys. So throughout this whole thing, I'll probably be asking you guys to press different buttons. But actually, one of the first questions I'm going to ask is, have you guys ever been on one of these before? You guys ever been on one of the a webinar that I've done before? I can't even see the chat. She said this is her first time. This is the last time all caught up. Look at that. I got another Turo. This is May. Let me go ahead and accept this. These folks loving my Turo car, getting booked up 2 months in advance. On weekly check-ins, first webinar. Hello, first time with you. Just been trying to get into options. It's been overwhelming. The goal of this is to make it so it's less overwhelming, because I think the people are trying to do too much, y'all. They're trying to do too much. And I've just been watching, I've been observing, and I've been seeing a lot of people do these a lot of people hop into options, but what I'm seeing is people quitting. And you guys are leaving too much money on the table to be quitting, too many opportunities to be quitting. And I think that there's a way to do options, and I think there's also a way to do options in 2022, because the world is changing. And so we got to have these conversations, and we got to have this discussion to make sure that we are utilizing strategies and we're looking at things that make sense today, because the stock market is ever changing. No 2 years are exactly alike. Just to kind of give you guys a rundown of what we're seeing right now, it's a very unique time. We're basically like on the edge of war, and stock markets don't typically fare too well during war times, especially when there's like the threat of war. So like in the beginning, when this whole like Putin thing was being alleged, the market was just getting crushed. So it can kind of make for a bad time to buy and hold, because stocks are just eroding away in value. People are becoming more fearful, and fear tends to make the stock market go down. Fear is what happened when the pandemic happened. So anytime that there's fear, uncertainty, and what some people call doubt, FUD, that's going to negatively impact the value of stocks. And so your longer contracts, your buy and hold stuff is going to be struggling. Personally, I think that might be a good opportunity to be buying more and doubling down and tripling down and looking for opportunities and things that make sense. It has to make sense. I'm really big on value, understanding what a company is worth, understanding. That's the guy I told you. What's going on, Sam? Understanding if you're buying something that might be overpriced. Oh, he definitely does. Hype and mania in the market, or and vice versa, course was something that might be underpriced due to a lot of the negative press that he didn't even have anything unfounded. That was like 1,000 or nothing. So before I go any further, like, we'll let you guys know that I'm not a financial advisor. That's how you know when people really making tons of money. Educational purposes only. If you do need information that's specifically dedicated to your circumstances, please seek a professional licensed financial advisor. But I'm really just here to offer the information that I know, the information that I've been digesting and researching and studying, in hopes that I can help you guys out a little bit. So, oh, my bad, you guys. Oh, hold on. Mute me. Participants. All right. My bad. I have my audio down. So anyway, yeah, not a financial advisor, but who am I? My name is Charles Oglesby, also known as Todd Millionaire. The company that I run and have built up is called Todd Capital. It's my baby. It's a company that I built after working with Edward Jones, working with Chase Private Client, working with a family office in the Orange County area, and realizing that I did all this work to get this education. I did all this work to learn how finance worked, learn how people build wealth, and I wasn't using it to help any of my people. It didn't make any sense to me. No offense to anybody who necessarily isn't, quote, my people, but it's not a matter of like one for the other, just making sure that my people are included. And I didn't want to make a living helping other people and then just like neglecting my own. So started creating some content, started creating some podcasts, started creating some blogs. We created an investment club that did really, really well. They gave us all the experience to invest and learn and talk and discuss things in real time, which was cool. That club grew to about 300 people. It was a really, really big club. It was just huge. We were kind of like the first of our kind. I tend to be a trailblazer in a lot of these places. But the way I even got the idea for the investment club is because when you work in wealth management, you get exposed to the other side of the veil, I say. So you get to see not only that wealthy people exist, but you get to see their finances. You get to see how they're structuring their deals. You get to see who's involved in their bank accounts, their credit card accounts. And one of the things that just kept coming up over and over and over again was teamwork. And I kept seeing people working together. I didn't see a lot of strong independentness over there, even in terms of like kids. One of my clients, this guy had like maybe like $900,000, just like a weird round number, $900,000. And he was just some kid out here living because his dad did really, really well. And so his dad did really well. He did enough. He did well enough so that he could just like pass cash to his son, and it's not a big deal. And so I started seeing like everybody's not out there making their kids struggle. Everybody's not out there making their kids grind it up and get it out the mud. And so I started seeing that there's a different way to do it. And I was like, I want my people to know this. And so I started writing blogs, started writing my podcast, doing things like that to let people know, like, this is how it's really done. And so really my whole thing is just like getting like, it's like Robin Hood. I don't take money from the rich. I take ideas from the rich and I give them to my people. So we're taking that wisdom, that knowledge, that information, that strategy, and we're bringing it to our people. Last year did really well in stocks. This year, Joe Biden's been killing my stock account. But we've had some really good days, but I want to say 2020, we crushed it, made multiple six figures. It was an amazing year. Thankfully, those are not realized capital gains, so I don't have to pay taxes on them yet. And then I've also had over 1,000% in stock options, which seems crazy. People laugh at it. And then you start seeing not just me who have done it, but a lot of people have done that with options. They're that powerful. But we got to harness that power. I don't want you just to unleash the power and just be out here just shocking yourself with the power. It's kind of like electricity. Electricity is very powerful. You can do a lot of things with electricity. You can also kill yourself. So you got to harness the power intelligently so that you can make sure that you can use it for good, not use it to kill yourself. So my option story is I started out buying stocks and I actually started opening up my first brokerage account when I was working at Edward Jones. I want to say that was in 2009. This is at the peak of the recession, and I bought some Bank of America stock, and it did pretty well. I only had like $300 or $400 to put into it. It did pretty well, but I mean, even despite it doing well, because I bought it on a dip, it still didn't really make that much money. It takes a lot to make money in stocks. Like a lot of us are looking to double and triple our money, and you're not going to get that just trading the flat stock market. It's very rare for a company to get 100% ROI, especially in less than a year. It's not going to happen. With options, it happens every day. So I wanted more movement. I went to penny stocks because the stuff that I had was just trading flat, and penny stocks are penny stocks for a reason. So if it's cheap for a reason. And then I realized, like, bro, I'm not going to make any money trading penny stocks. Are there people who do it? Absolutely. But that just wasn't what fit for me. So I started to swing trade earnings because I noticed that when earnings released, the stock would jump like really a lot of percentage, like 10, 20%, 30%. And I was like, man, I can make some money in this if I position myself correctly. So I started to do that. But what I would do is instead of putting like a little bit of money, like $300, $400, I'll put like $5,000 and $10,000 behind a position, like almost all of my portfolio, if not all of my portfolio. And I did pretty well. Only had one bad trade. That was, I think, Bank of America. They had like reported good earnings and it still tanked. It was bad. I had never lost that much money in my life. But the amount of money that I lost compared to what I have made paled in comparison. My worst loss was like $2,000, and I made like $25,000 trading options that year. So I think what's important when you're trading options, because it's not easy. It's not easy. You got to find your why. Why are you doing this? Why are you doing this outside of just taking a vacation? Because vacations are fleeting, but your kids are not. Your wife is not. Your mom is not. And the people, your student loans are not. The people that attach themselves to a why are you trading? Those are the people that put the time, effort, and energy into this thing so that they can do well. So I challenge you, before you start studying, figure out why you're doing it. Because if you have not identified why you're doing it, you're going to cheat yourself. You're going to half-ass the work. You're going to half-ass the energy. You're going to try it. You're going to be like, oh, this doesn't work for me. You're going to quit. But it does work. And I've seen it work for a ton of people. I know it can work for you. At first, I was scared because I was like, man, options are risky. Electricity, they can kill you. And I released the course. People started taking the course and people were crushing it with the course. And I was like, wow, like, I think I kind of like doubted my people. The same people that I told you I wanted to save, I'm over here thinking maybe they can't harness the power of options. Lo and behold, they could. So I don't want to go too deep into options. I really want to talk to you guys more about how we're going to utilize this in 2022. But for the new people here, I do want to touch on this. So basic stock trading terms. This really just talks about the different kinds of orders. So you have a limit order, a market order, good until cancel order, a day order, scaling in, scaling out, averaging up, and averaging down. So when you buy a stock, you can have either a limit order or a market order. A market order means you're just buying it right at the current price. There's no special anything. A limit order kind of gives you insurance. So it says I'm going to buy it at this price or better. The goal is to buy low, so it's going to buy it at that price or lower. So the stock is trading at $16. You're going to say I want to buy it at $16 or lower, $17 or lower. So if you set a limit order at $17, it's going to execute at the current stock price. But what it's going to protect you against is if that price runs, because you don't want to buy it too high. So you don't want to be analyzing a stock based on it being at $16 and you put in a market order and it jumps to $20 and you end up buying it at $20. And now you got to wait for it to go even higher for you to make money. Well, maybe your analysis didn't indicate that that was the range within it was trading. Good until cancel in a day order. It's just kind of as it sounds. These aren't that important, but I've found that sometimes people get in the middle of a trade and they're like, what the heck is a market order? What's a limit order? How do I get out of this thing? So a day order really just, it expires at the end of the day if it doesn't trigger. Good until cancel order, it expires, it runs until it's canceled. Now, if you have a market order, good until cancel or a day order is likely not going to matter because it's just going to trigger anyway. That good until cancel and day order is really going to matter as it turns to a limit order, because if your limit's not met, it can either cancel it when you decide to cancel it or cancel it at the end of that day, end of that trading day. Scaling in, scaling out, averaging up and averaging down are about the same thing. Basically, I tell people, and this is actually relevant to 2020, is you don't want to enter in a position full retard. You don't want to identify an opportunity and say you have maybe, let's hypothetically say $10,000. You're like, okay, I'm going to put all 10 into that. No, the more intelligent thing to do is to buy a little and then see what happens and buy a little bit more, see what happens. And then opposite side is when you're selling. And this happened to me recently. I had a great trade. I bought SPGI, which is the S&P index fund. And I bought at the support. It ran to a good level. I took profits, but I had 5 contracts. I sold all 5 contracts. A more intelligent thing would have been to sell maybe 3 contracts and let the other 2 contracts run, because the very next day it ran up $10 a share. I left $2,000 on the table. I actually left, if I would have held it, I would have made $5,000. But if I'd have sold those 3, I would have made the $1,000 that I made and then still made another $2,000 on top of that. So scaling out is really important. You just want to, if you identify a good opportunity as doing what you want to do, don't just sell it all. Take your profits. So options, stock market. I'm sure you guys are familiar with the stock market. Anybody here not ever heard of the stock market? Anybody? Where are my chats at? Chat. Anybody not heard of the stock market? One, if you have not heard of the stock market, I don't believe that anybody's not heard of the stock market. But what's cool is there's these things called derivatives. And so futures are derivatives, but option contracts are derivatives. So when you're investing with options and stock options, you're not actually buying the stock. What you're buying is a contract, which is the right, but not the obligation to buy a certain asset at a certain price. So what happens is that contract gives you 100 shares. And the good thing about that is that gives you leverage. And so now you're controlling 100 shares of that stock, which is likely, depending on the stock, unlikely. A lot of people don't buy 100 shares of one stock. They might buy 2, 3, 4 shares. We can use Netflix as an example. Netflix, I want to say, is trading around $300 a share. Add $100 to that. Add 102 zeros to that. 300. Now you're looking at, I want to say, like 3,000, 30,000. Say 30,000. That's what I think. Calc. That's one of them. 300. Add 2 zeros. 300 times 100. Yeah, 30,000. That's what I thought. So who has $30,000 here to invest in Netflix options or invest in stock at all? Not a lot of people, but you have the ability to access that for a fraction of the price when you buy option contracts. Let's see if I can show you. All right. So we're going to look at it's Netflix really quick. We're going to go to trade Netflix options. Now, trading at 370, that means it must have did really well today. So you can buy one contract of, granted, this expires on the 18th, so we don't really want that. Let's push it out to the 25th next week. Still, it's going to be pretty affordable. So what would it cost us $30,000? We can buy it for $1,000 or $900. You're going to take that 9 multiplied times 100. You're going to get that. Now, let's say, for example, you just want to gamble and see if it pops tomorrow. You can get it for even less. And so now we're going to be getting access to 100 shares of Netflix, which is $30,000 for $300. So if you look at here, 3.38, the total cost of that contract is going to be $340. So Netflix popped 3.6% today. Now with Netflix, that's a pretty big deal because it's such a large company that 3% is $13. Don't know of any Europe, Netherlands-based platforms to trade options. I've heard something called Tastyworks. That's what people, I think, have used. But one thing I will say is that if you Google it, you might have way more success because I don't really specialize in that. So I'd only be giving you an estimate or a guess, and I could probably lead you down the wrong way. Why are options powerful? Because that leverage. So just like I just showed you, 100 shares of this company, Spotify, this is an old slide, so this number might have changed, could cost you $28,000, where it's let's assume it's a $280 stock times 100, you're going to be paying $28,000. I bought this contract for $1,000, a fraction of the price, and that $1,000 contract allowed me to control $28,000. So let's say you have $28,000 and the stock goes up $10 a share. So you're going to be that. So let's say $10 on 26 or 260, $10 divided by 260 is a 4% return. So 4%, 0.04 times 28,000 will give you the $1,100 that you profited. So you're able to profit as if you own it with only a fraction. And now what's cool is it's the ROI, but really it's the cash on cash return. So we're looking at the cash you put in plus the cash you get back based on the cash that you put in. So if you would have invested 28,000 and you would have made that $1,100, you might not be that excited because it's only 4%, very small return on investment. But since you only invested 1,000 and you got 1,000 back, you actually doubled your money. You got 100% return on investment. And that's why options are powerful. It allows you to control a lot with a little bit of money. That's what makes real estate powerful as well. And then the exponential upside. So if you see here, this return on investment was 1,866%. So small money can lead you to large money. So that's really the whole gist of this. I know a lot of people, they get excited about options and they look at how much money they can make. And so they say, hey, if I can make 1,866% off of uh, $90. How much can I make if I put up 900? How much can I make if I put up 9,000? And that's where the problems arise. If you are not so confident in your play, if you are not so confident in your skills, you got to play it small. But the beauty of it is if you play it small and you play it right, you can still do really well. So I tell people that you manage your risk by managing what you put at risk. Risk management is huge, especially when you're playing with electricity. If you're playing with electricity, we got to make sure that we're managing our risk and that we're not just out here letting it all hang out. And a lot of people let it all hang out. And I think they don't do it because they are highly risk averse. I think it's a function of laziness. People don't want to do the work. And so they just gamble. Gambling is where you just kind of hope. And so you're like, well, I hope this plays out. Like, no. Do you know that you know that you know that you know? I'm going to talk to you guys about that later. You got to treat it like a job if you want to make some dough. I'm going to show you guys what that job looks like. Limited risk. You limit what you put at risk. You don't have to necessarily even put up $1,000 per trade. You can put $100 per trade, just like that person did. You can put up $200 per trade. And I really think that you should. In fact, I think you should start trading paper in the beginning. I don't think you should even hop right to live trading, and definitely don't be throwing thousands at nothing. Please not throw thousands at something. The amount of time that it takes for you to make that money on the job or whatever you do in business, please use that, match that time with the time that you study what you're going to be buying. And this is why I tell people that you have to focus on one stock. Focus on one stock, preferably an ETF, something that is diversified, something that doesn't move super fast, something that is moderately predictable. And so what we use is the SPY. SPY, which is the S&P index, is what I would recommend for you to learn with. And it's not fun. And if you're not going to use SPY, use QQQ. But I really recommend that you use something like this, something that you can map out the trends, you can see where it's going in a general direction, and you can start looking at your entries and your exits based off of the trend lines, the support and resistance, and all that good stuff, moving averages and whatnot. But you can see the overall consensus of the market, and following the news, following the politics is going to help you do that better. So I think that anybody starting, you get to pick one of two, either SPY or QQQ. QQQ is the NASDAQ. So that's all the tech companies. Now, all tech's not created equal. So I think that that's going to be kind of tough because you have, it's so many crossovers in here. I want to say Tesla's on the NASDAQ. You got Tesla on the NASDAQ. You have newer companies on the NASDAQ. It actually is going to show you. So you got Apple, Microsoft, Amazon, NVIDIA and Amazon, Tesla, Google, Broadcom, Costco. So it's like, yeah, it's there, but there's kind of no rhyme or reason to that. Whereas the S&P index is generally known as the entire stock market. So you can kind of track the economy. Are things getting better? Are things getting worse? Is the consensus really negative? Is the consensus positive? And you can match that with the chart, because just as much as you want to look at the chart, you want to look at these articles. Then you got to be doing your homework. But again, you can only really risk what you put at risk. So these are a few different strategies. You have momentum, buy and hold, long or short, index fund, pairs trading, contrarian investing, growth or value. We're really just talking about like long and short or momentum. I can't think of anything else that would be really relevant to this conversation. So these are some rookie mistakes that I see a lot of people what a lot of people go through, and I don't like seeing it, man. I'm like, let me see one thing. Let me see one thing. All right, cool. I just want to make sure that you guys can see me. We got people watching on YouTube. Shout out to those good peeps. Let me go ahead and share it again. So rookie mistakes: starting with too much money, wants to get rich quick, believes the low cheap price equals cheap, panic sells during a market crash, falls for FOMO, trying to catch falling knives, waiting for better times. Anybody here, drop a 1 in the chat if you're guilty of any of these things. Drop a 1 in the chat if you're guilty of any of these things. Drop a 1 in the chat if you've ever done one of these. I would say one of the things that I see happen a lot would be FOMO and starting with too much money and maybe panic sales. So I'm going to address a few of those once I get towards the end, the actual slides. But yeah, please, 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 all of these are bad habits, and they're rookie mistakes. And I think that maybe it can be a part of marketing. People think that it's going to be easy, it's going to be quick. They think that they're going to just make a bunch of money. And while I do think that it's possible to make good money fast, I don't want you to think that that's the ordinary thing. A lot of people who were just running it up super fast, that was 2020. This ain't 2020. A lot of people who criticize my strategy of swing trading earnings now make all the money swing trading earnings, because swing trading earnings is lucrative, way more lucrative. Bryce Moses said he's guilty of every one. Yep. So please leverage paper trading. I encourage you to practice. Trade with the group, focus on the same stocks over and over again, stay small. And also what's really important is keeping a trading journal. You would be surprised that you actually do better than you think you do, but you don't keep track of the good things that you do. So you only notice that you messed up on one trade, but you don't notice that you've made like 5 other good trades in the past. And so maybe it's just that one, because sometimes the market can be unpredictable, where you've done every single thing right, and then you still kind of fall on your face. I don't want that for you guys, and I don't think it's necessary. So that's why you got to keep track of your wins. Don't get too high on the highs, but don't get too low on your lows. It's possible, and just keep chunking at it. But paper trading is so key. It takes away a lot of the fear that goes along with it. I think you should be paper trading, even if you're trading in real life, because you can be using different strategies. Now, what's cool about Thinkorswim is they give you different strategies. So you can be trying those out, trying different iron condors and these spreads, verticals, diagonals, that really cool stuff that can help you mitigate your risk, because you're combining selling option contracts with buying option contracts. So for those who don't know, you can actually sell a contract as well. You don't just have to buy contracts. So there's some people who just make money selling covered puts, or selling covered calls rather, or cash secured puts. This person says Thinkorswim is so complicated. It is complicated, and I think that the only way that you uncomplicate it is through practice. And you're going to get that practice by trading paper. And you probably might even make some mistakes. I made a huge mistake on Thinkorswim, a huge mistake. Hopefully the government lets me count it against my taxes, but you're going to get over the it's going to be less complicated the more that you use it, the more that you get in there, and the more that you just kind of try it out. One thing I like about Thinkorswim is they have a web version. It's a little bit easier to navigate. But yeah, paper trade either through TD Ameritrade, Thinkorswim, or Webull. And there's other ones out there, but I personally like Thinkorswim better than Webull, because Webull is kind of weird. When you do it on a phone, like the buttons are really small and you can accidentally click the wrong thing. So pick your trading style, time frame. You can have a scalp, a swing, an intraday, or a position. I don't think either of those are necessarily good or bad. All that really changes is the time frame of your chart. So if you're looking to scalp, or if you're looking to scalp, you're probably going to look at like a one-day chart. You're just going to be analyzing that one-day chart as if you'll be analyzing a long-term chart. The chart is the chart is the chart. The patterns are the patterns of the patterns. The patterns on the small-term chart are the same thing as a pattern on the long-term chart. But what matters is your time horizon. How long do you plan on being in that trade? Do you plan on being in that trade for a day, 2 days? Well, you don't need to be looking at a year-long chart. It's probably going to confuse you. Granted, I think that the overall consensus can help you, but if you're looking to scalp, you don't need to look at a long-term chart. If you're looking to do a long-term position chart, don't be looking at the day chart, because the day chart is not as relevant. And you also don't want to get too caught up in that short-term movement. So if you've seen that one chart that I put out on my Instagram where it shows the up and down of the stock market, and it shows that, man, that's so annoying. It shows that like when you're a long-term trader, you're happy when it's up, you're happy when it's down. But when you're a short-term trader, you're happy when it's up, and then you're sad when it's down. But you got to just determine what your strategy is. Neither is necessarily good or bad, in my opinion. Analysis. This is so important. I believe in a hybrid analysis. I don't think it should just be purely technical or purely fundamental. There's people who are purely technical and they don't care nothing about the fundamentals. There's people who are purely fundamentals. They don't care anything about the technicals. What is fundamental analysis? Fundamental analysis is when you're actually looking at the inner workings of the company, their profit and their losses, their balance sheet, their profitability ratios, that kind of stuff. Any maybe new company, new businesses or new products they might be coming out with, that kind of stuff matters. When you're looking at technical, all you're looking at is chart patterns, you're looking at triangles, wedges, you're looking at double tops, you're looking at head and shoulders, you're looking at cup and handles, all that stuff. I like to use both. I think both are relevant because technical is going to show you what the actual day-to-day looks like and what the people who are really active trading in this. But fundamental is good for long-term. Fundamental is great for earnings season because earnings season is really based on the actual profitability of the company, and that's nothing to do with the chart. So it all depends on what you're doing, but I recommend learning both. I have a course that teaches both. Crisis Money teaches fundamental analysis, and the technical analysis tutorial teaches you technical analysis. I like to combine them both. So I'm sure you guys have heard bullish and bearish. Bullish just basically means that it's optimistic. We think the stock is going to go up, and bearish means it's mostly negative. The market is more bullish than it is bearish. A lot of people say that the market is rigged to stay up. I kind of agree with that sentiment, and that's why you got to have patience, even in times like this. So right now, a lot of people are up short term, but down long term. I think that you have to be patient and wait it out, because I've seen stocks, man, so many stocks that I bought a long time ago that I thought that I was a genius because I made a good trade on them, that I looked like an idiot because I didn't hold them as investments. So I'm not really too focused for my long-term stuff on what it's doing day to day. I like looking at it because it's fun to see the market, the money go up and down, but I'm more concerned with where we're going. And I know that it's just going to work out better. So I'm just getting back into business, getting back into generating revenue, income, and all that kind of stuff so I can continue to stack money, new money, because the opportunities and finding the new opportunities. We're going to talk about where I think some opportunities are in the stock market. Somebody said, what's trading earnings? Trading earnings is essentially this. So every 3 months, each company, because they are publicly traded companies, meaning that they're owned by the public, they're not owned by a private entity, they have to come out and they have to tell you how much money they made for that quarter. And they do that by reporting the earnings per share number. And so earnings is the earnings per share. And what happens is you have analysts who predict it based off of usually what the company forecasts. The company forecast, analysts look at information and they basically determine if they agree or they disagree. They think that they're going to beat or miss earnings. And then what happens is the company tells you the real thing. And so typically what happens is, I can't use QQQ. Let's use Amazon. I don't know when they just released earnings. So Amazon releases earnings April 23rd. So what I like to look at is the 3-year chart. And so this is when they released earnings, kind of, sort of. They released earnings last, this will tell you, Q4. Let's just say it was January, late January. So late January, it was around here. And so what I'm looking at is this period between here, January, and here is all noise. We don't know what is actually happening. It's just all people guessing and people writing articles and people doing stuff like this, saying, oh, Federal Labor Board seeks to force Amazon to reinstate fired worker, FTC and Nemesis. Amazon completes $8.5 million MGM deal, which we didn't know about. I didn't know about that. Amazon. So I like to look at this, what the bulls say and what the bears say. That's important. And then you have to kind of make an educated guess. Now you can do this one of two ways. You can either go long or short it by buying puts or calls, or sometimes you can just go neutral and you can buy both calls and puts if you think the pool is going to be big enough. So if you don't know which way it's going to go, you can always just buy a straddle. You can go either way. Again, risk what you have at risk, because earnings is very unpredictable. And if you miss earnings, it could crush the value of that stock. So we do things to help prevent that. We don't want to buy a stock that's reporting earnings very close to the time that they're reporting earnings, because at that point in time, the implied volatility is heightened, and implied volatility is one of the things that determines a option contract's value at that time, because they know it's going to move. But implied volatility is no respecter of direction. Implied volatility says we think it's going to move. It doesn't tell you if it's going to move up or down. So you don't really know that until it releases. But you like to do your analysis based off of all the fundamentals and the direction of the chart leading up into earnings. So where was I going with that? I forgot where I was going with that. Yeah, they can be unpredictable. So let's just make sure that if you choose to go this route, that we are having the correct position size, which I'm going to talk about shortly. Tools of the trade. So these are all the technical indicators for options. You have the MACD, the RSI, the Bollinger Bands, moving averages, ATR, the ADX, the Keltner channels, and extension from the mean. So I like to use, if anything, I'm using RSI and moving averages. Bollinger Bands are pretty helpful just because they kind of show you the trading range. But all of these are lagging indicators, which means that they can't tell you what's going to happen. They can only tell you what's happened. So you have to take them with a grain of salt. Moving averages are very helpful because typically what happens is the stock's going to move towards the mean. So you want to have a long-term moving average and a short-term moving average. Long-term could be like a 7-day moving average or a 30-day moving average. Then a long-term is going to be like a 200-day moving average. You can determine if it's overbought or oversold by looking at that. You can also determine the support and resistance by looking at that. And then lastly, just focus on what you control. You can't control price action. You can't, as much as people like to pretend that they can, you can't. What you can control are your exits, your entries, your mindset, your work ethic, your time frame, your confidence, your screen time, your belief system, your position sizing, your reaction to news, your emotional reactions, and who you listen to. So now I'm going to get into the 2022 thing. What is the most important is position sizing. Risk what you put at risk. I've talked about this a lot of times, but I'm so tired of seeing people say they lost a lot of money because they're putting a lot of money up. I don't want you putting a lot on. Trade paper until you can't get it wrong. Don't trade until you get it right a few times. Trade until you can't get it wrong. A lot of people, they get in this thing and they're chasing that fast money. All the things we talked about, getting rich quick, FOMO, falling knives, all that stuff. But what you really need to do is you owe it to yourself to maintain a proper position size because the upside is so substantial. $100 position can turn into $1,000 position very easy, but $1,000 position could turn into a $0 position. And I don't want that for any of you guys. So until you can't get it wrong, we need to continue to keep these trades small. I don't want nobody out there getting ahead of themselves and losing money because they wanted to cheap or to shortcut it. So position sizing in 2022, where we're in a market where it's kind of unpredictable, where one day it can be up really high, the next day it could be the end of the world. That's what we're seeing. We don't even know, especially with this war, we really don't know what's going to go on. It's a new development every single day. And so you have to be able to be comfortable with knowing what you don't know. And we really don't know what they're going to do about this war. So let's not act as though we do. I know people who are trading oil and they got clapped. And so be smart. Let's shrink those position sizes and let's just get really good at hitting base hits. Let's get really good at just getting that 10, 20%. A lot of people, what they do is they come in trying to double and triple their money. And then they're like, nah, I'm good on that. Let me just get a good 20 to 40% and I'm happy, because a small win is better than a huge loss. And a lot of people, they're passing up small wins and they get stuck with a huge loss. And those losses are unforgiving. The next thing is focus. Find one stock, one ETF, and own the hell out of that stock. Own the hell out of it. Know its levels. So when we're looking at, this isn't going to be good. Let me see if I can pull up TD Ameritrade. Don't try to hack me, y'all. So what I like to do is SPY. So what I'm going to do is I'm just going to look at the price levels. I'm going to give myself a week chart, and I'm going to draw in my trend lines. And that's going to determine where the support and resistance is. I also like to use price levels. Now, this is a weak chart for the S&P index, so it's kind of not helpful. I mean, it's helpful if you're looking at just like short-term stuff, but the long-term S&P has been getting crushed. But this kind of shows you your support and your resistance. Some people call it supply and demand, where since the stock is trading up against here, either we can project that it's going to continue to go up, hence the trend lines, or we can trade this range. But I don't think that it's going to correct down. So if we're looking like the month, or let's go a longer time period, like a year. So I'm pretty sure it was like on a negative trend. This is a 3-year 1-day chart, 3-year 1 week. So it actually still looks pretty optimistic. And so one of the things I like to do is I like to look at different variations of the time, because if you're just looking at like a short term, it can kind of be misleading. But what I'm seeing here, I like this, but this is SPX, which is essentially the same thing, just a variation of the S&P index. So what I would take from here is I think that I'm pretty bullish long term. Short term, we might get some turbulence. So you might get some little pullback short term, but the overall trend of the S&P index, and this is why it's good to smooth out the lines. So trend lines smooth out the lines. So it's easy to get caught up and say, oh man, it's going up, it's going down, it's going up, it's going down. It's like, which way is it going? Well, let's look at the trend lines. Trend lines are going to smooth it out. And so we know that it's headed on a positive trajectory. So, but the thing is own one stock. A lot of people, what they do is they'll do all this analysis on SPY and they'll get it, and then they won't test it. And then what'll happen is somebody will call out something. They'll say, buy Snow, buy this company, buy that company. And now they're chasing it around. They got to learn a whole new chart. When this is easy money, you don't got to do nothing else but just trade this, because the way that you make more money isn't necessarily by finding the better stock. It's by opening up a larger position in the stock that you already know. So if you know that this stock is going to do this and this, if you know when it dips here, it usually runs up, or when it dips here, it usually runs up, or when it dips here, it usually runs up, and you've already kind of identified this as a support level, you could have been trading this here. This little range right here, you could just be trading that. But if you know what's going on, all you got to do is increase your position size. That's how you make the money. So find out how you need to learn one stock. Don't be chasing everything, because people who have chased everything have gotten clapped. Every single company that I've seen, man, NEO is the most recent victim. If you look at NEO's chart, they don't really show you that on TD Ameritrade, all the numbers. They have good charting tools, but so NEO used to be really, really big, and now it's down 37%. Now it's down 56%. And I know people who are holding on to NEO for dear life. They thought NEO was the future, and NEO might be the future, but the future is a long way out, y'all. And that's one thing that I learned through my experiences. The future is a long way out. I owned Tesla when it was $100 a share. I thought I was the man. I think I bought it at like $80. It ran up to like 120. I thought I was the best trader in the history of trades. I made like $3,000 overnight. I was so happy. I never made that much money overnight in my life. This was years ago. $100 Tesla, it's a long time ago. But I look like a retard now, because imagine if I kept that $100 stock. So the future, there's two things, is like patience, which is one of the things we're going to go over next. But it takes a long time for the future to come. Metaverse. We all thought the metaverse was coming, and then everybody bought into Facebook, and then Facebook got hammered. Want to know why? For the same reason I told you guys, companies get hammered, because when you have when you have like in between earnings reports, you have a lot of hype. So in between this period and the 3 month period before then, that's when they announced they're changing the name to Meta. They're going bullish on the metaverse. Everybody's like, man, you got to get your NFTs, you got to get your meta stuff, but they don't realize that's a long way out, you guys. And so when they reported earnings, the earnings couldn't substantiate that current value. And so what happened is it corrected downward to the true value, because at the end of the day, the company is worth the money that it generates, not the hype that it generates. So focus. Don't be out there chasing all this stuff, y'all. That's how you get clapped. Focus, focus, focus. So please type which stock you're going to focus on, because I want to know. I want you guys to pick which you're going to focus on. Is it going to be SPY? Is it going to be QQQ? Or is it going to be something else? But focus on one and pick one and chart the hell out of that. Only look at that stock. Only research that stock. Only focus on that stock. What's your one? I got Vanessa saying SPY, Anthony saying SPY, Onisa saying Amazon. I like it. I'm okay with that. Kelsey says QQQ. And V says QQQ. Sam, you got to pick one, brother. I can't have you doing both because those are two different things, man. S&P is the entire index and QQQ is just the tech. And so one moves faster than the other. The QQQ is way more volatile than the S&P index. So pick one. Pick one. Tesla, that's kind of tough, man. All right. She said she's been, this person says they've been successfully trading Apple in their paper account. I love it. Yes, focus on one. That is how you're going to be good in 2022, because the market is crazy. I remember about 3 or 4 years ago, I was just crushing it with Apple or with Under Armour. I was crushing it. I bought it at like $50. It ran to $100, and then they did a stock split, and so the stock split took it down to $50, and I ran it right back up to $100. I was the man. I knew everything about Under Armour. I knew everything. I knew the CEO. I knew where he went to school. I knew why he created the company. I knew the products they're coming out with. I don't think a lot of people know that much about the companies that they're trading. I don't. I think they just know that somebody said it's going to go up. So I want you guys to know that about your index. And if it's the S&P, you got to know what's going on macroeconomically. You got to know what's going on nationwide with the entire stock market. And the more knowledgeable you are, the more money you're going to make, the easier you're going to be able to pivot and adjust and dominate. And then at that point, once you have so much knowledge about your one security, now we're just scaling up the positions. That's how you make your money. You start scaling up the positions, or you start selling contracts against your positions because you just know it. It's a game of knowledge. Investing is a game of knowledge. Gambling is a game of chance. And a lot of people apply chance to the stock market when you don't have to, because you have the ability to read the annual reports. You have the ability to research the investor news. You have the ability to watch investor news. All that stuff. Focus on one and own it. Don't sleep on support and resistance. And my typo. Don't sleep on support and resistance. Trade the range, just like I kind of showed you. You can spot what's going on just by charting that support and resistance. You can see where it's going, where it's been. You can see this is how you trade. That's all it is. Trade is charting the levels and then trading within those levels. That's it. But you have to trust your levels. I think that's one of the most important things. Is you don't want to chart out something and then when it goes against you, you question it. An example of that would be recently, I want to say SPGI. Was SPGI was just SPY? I don't know why. There's so many different things out there now. SPY or SPGI. Look at all these things. Like, geez. So I want to say I was looking at this day chart. Let's go to 3 days. And it was like an intraday chart. And I want to say it was running one of these. It was like running, and it had like a long red candle. And so you start thinking that the trend is that it's going down, and you start thinking that this big red candle is like confirmation is going to continue to go down, and then it corrects up. But if you've been doing your chart, you know that it's on a trend up. The short term doesn't matter. The overall trend is your friend. The trend is your friend. Find the trend, find your levels, and trade within your levels. So here, we could argue that it might pull back, and it's likely to pull back because now it's at a new top. zoom out. And so really it's just about finding those price levels. And when you're finding a price level, realize that like there's no right or wrong price level. It's all the estimate. So you just want to draw as many as you can to kind of get a good roadmap of what's what. So we see like some support right there. That could be a potential support level. It's not going to always hit the bottom of every candle. It's just kind of like an estimate. So here we could potentially have a trading range where if you were to buy puts here, we'd run it as far down as it would go, and it can either go here or it could press through there and it can go to the next one. But that's going to be important to look at the news as well. So what I like about TD Ameritrade or Thinkorswim is they have all these articles down here, So with Robinhood, they have them too, but with Thinkorswim, they also have more articles. You can just read it right there, and you should be reading that at least one a day. The support and resistance are really, really important. Make sure you chart the support and the resistance or the trend lines, because if it's going up at a slope, you're not necessarily going to have support and resistance. It might just be that the trend lines, but the trend lines function as support and resistance. So if it's trading within the trend, the support and resistance is just going to be diagonal as opposed to straight across. One thing that you have to have is patience. Trust your gut. Don't get shaken out of position. If you have mapped it out, if you have drawn out your chart, trust your chart. Don't do all that work and then get shaken out of it. Trust your chart. You can always scale in, you can always scale out, but the most important thing is to trust what you've done. In this market, you got to seek value. There's some opportunities out there. One of my favorite opportunities is Netflix. Netflix is going through some trouble, but it's still a quality company. So I'm looking at that long-term chart and I'm seeing like, bro, this is down 37%. I need to buy some more. I only have one share of Netflix. So I'm always looking for bad press on great companies. If you're looking for an opportunity in 2022, I think Netflix is a great opportunity to get some shares in a quality company. But the thing is a lot of people there looking at where it is now compared to where it fell from. My thing is, and I've always said this, I don't need it to go back to where it fell from. I just know that here it might be a little bit oversold. So it's trading down here around 369 at its high. It was trading at like 687. If it goes back here, I'm happy. If it goes from 369 to 500, that's like 30%. And if you apply some long-term options, then that's good. Long-term options are called leaps. And why those are important is because every move isn't going to be a fast move, but you should be able to take advantage of that move. So, man, if you buy some contracts that are a year out, if you buy some contracts that are 2 years out, then you will be in really, really good position as this company starts to recover. And you still have the same access. You're still going to have access to the 100 shares, which is $30,000. We get imagine that it goes from 360 to 500. Now we're looking at about $140 per share on the move, times $140 times 100. Best case scenario, you make $14,000. Best case scenario, and that's if it only goes there. And that's a rough estimate. It can be a little bit different. A lot of people don't like my flat math, but I think that is one of the best ways to understand options, is that for every dollar that it goes up is essentially $100 because you have 100 shares. So you can take that 140, add 2 zeros, boom. It's going to be a rough number. It might not be 14,000, it might be like 11,000, but just know it's going to be a pretty substantial number. The only thing with long-term options is they are expensive, but they're less risky. So let's say we buy January 2023, which is about 8 months out. Now you look here and it's going to be expensive. So this is going to be about a $5,000 contract, $6,000 contract. The good thing about it being so long out is it's also less volatile. So the theta is cheaper. So if we're looking at the Greeks, we're going to look at how much it's going to lose per day. It's going to lose about 9 cents a day, which isn't that much money. And then the delta is still strong, because if you look at the delta shows you how much is going to move for the next dollar that it goes up in value. But if you look at the delta on a short-term option, it's going to be about the same because it's at the money. So if we're looking at the delta here, still about the same. The delta is the same, but the theta is way more expensive. And so if you go longer term on your contracts, you're able to kind of hedge your bets and kind of make it a little bit more less risky. And that's why a lot of people, that's all they believe in, is doing that. Is because you kind of get the best of both worlds. You get the power of options without having to worry about your stock going to zero tomorrow, because there's so much time left in the contract to make your money back. The answer is, will there be a recording? I don't know. So seek value. I like Netflix. I also like Facebook. You already saw that I bought some Facebook. I actually bought it on the dip. Granted, I'm down like 13%. I'm patient. I'm very patient. And like I said, I don't need it to go back to where it fell from. But I have a feeling that they're on to something with that Meta. I just think it got a little bit ahead of itself, and the valuation skyrocketed. And so I didn't buy at the top, y'all. I didn't buy when people were hyping up Meta here. I bought it when people were like, damn, maybe Meta ain't all that. So what's going to likely happen is over the next 3 months, some good news is going to come out. They're going to have some development, something that's going to bring that stock price back up. And I'm going to be making money because I buy the bad news, not the good news. So seek the bad news in this market. Wherever you see bad news, seek that. These are just the most obvious plays that stand out to me, outside of me going into one of my next ones, which is play politics. We're in a way new industry, or way new administration. And so there's opportunity. I think there's opportunity in electric vehicles, because that's the way they're trying to push people. I think that there's opportunity in weed and defense companies, because now we're teetering on the edge of war. And so I think you got to search for those as well. Gas prices are going up, but that doesn't necessarily mean that gas companies are going to be doing well, because people might just be getting sick of paying all that money for gas, which could have a negative effect on your companies like Exxon and Shell and BP. So that could be an opportunity to buy puts on something like that. But you got to know what's going on in the world in terms of politics. One of my favorite opportunities is weed. I'm really banking on weed becoming legal. Now, this is one of my worst stocks. What's Canopy Growth? CGC. That's not a good one. But Canopy Growth, I bought it off the bottom. And if you look at their long-term chart, like, they're trading super low. So I'm the guy who's buying stocks right here. I bought Aurora Cannabis and I did really well, and then it kind of flipped on me. So I'm still waiting for that to come back. But at its height, this is a $50 stock that's trading at $6. So I bought some at $6.14. And now I'm just waiting for it to become legal. And that's one of the things that they're talking about, is the legalization. They actually have like deals in place as it becomes legal. So I like weed companies. I like to play politics and see. You got to forecast. We got to see where the world is going. That's one of the things that you really got to be looking at, is like, where is the world trending towards? What do I know about Joe Biden? What do I know about Kamala Harris? Unfortunately, when they got elected, private prison stocks jumped. Take with that what you want. Some people ethically still want to invest in those, and I think I'm one of those guys. Lastly, you guys, treat it like a job. Get the courses, get the books, get the podcasts, and really commit to what you're doing. Because it's a job, and it's going to pay you, actually going to pay you much more than a job would pay you. So really get in there, look at your charts. I know it's going to be boring. I know trading one is going to be boring. You're not going to like it. But I had a mentee, and she was working with me, and she got tired because it was boring, because I had her going wax on, wax off, wax on, wax off, wax on, wax off. She's like, I don't want to do the wax on, wax off stuff. And then she went off, and I followed her page, and I was like, I see you over there still doing the same stuff that I told you. You went to another mentor. He told you to do the same exact thing. So don't think that another mentor is going to be the key to your success. Sometimes the key to your success, not sometimes, the key to your success is doing the work, y'all. Either you do the work and you grow, or you don't do the work and you stay in the same place. With these fundamentals, guys, I really don't see how you could lose. I really don't. Yeah, that's all I got. That's all I got. You guys can grab the full course, optionswithtodd.com. Use code webinar. You get 40% off. That course is stacked, honestly. Where it started compared to where it is now, it's crazy. It has the technical analysis tutorial. I'm talking about earnings, Q&A slides. It's just a lot in there. So check that out. And then we also have an options and wealth community where it's not like we're not giving you the game. We're really just there to answer questions about general stock market stuff if you have it. So thanks, Julian. I appreciate that compliment. Thanks, Sam. Always see you on the internet. Shout out to you guys for being here. What I'll do is I will email this out to the people who stayed to the end. And that's all I got. That's all I got. We in a whole hour. I wasn't expecting to go a whole hour, but hopefully you guys took something from this. Nick, if you need a one-on-one tutor session, you should be able to go here. You should be able to go here. Oh, looking at book Todd Cap. There should be an option there. But other than that, I'll see you guys around. Thanks for tuning in. It's cool that we got the numbers that we gotten here. I had a good time. I will see you guys in the next one. I mean, I got to Instagram this. I got to Gram this. All right, I'll see you guys. Thanks.